FTX and Silicon Valley Bank, two financial giants that collapsed in a matter of months, exposing a deep-seated culture of fraud and corruption. These scandals, which wiped out billions of dollars in investor and customer funds, have shaken the financial world to its core. But do they really tell us about the state of our financial system? Hello, and welcome back to Serious Coinage. In this video, we'll take a deep dive into the FTX and SVB scandals, examining the root causes of these failures and the lessons we can learn from them. We'll also look at the broader implications of these scandals for the financial system as a whole and what we can do to protect ourselves from future fraud. When it came to buying and selling cryptocurrencies, FTX was a major marketplace. The platforms gained popularity as more individuals began to invest in cryptocurrencies because they allowed users to keep their crypto holdings in a secure digital wallet. FTX was one of the most popular trading platforms up until the end of 2022. In 2019, Sam Bankman-Fried launched FTX. Customers started opening FTX accounts to buy and trade cryptocurrencies, and prestigious venture capitalists flocked in. FTX was worth $32 billion by January 2022. After launching, FTX soon rose to dominance in its market by purchasing well-known but failing rivals including Liquid Global, LedgerX, and Blockfolio. Super Bowl commercials, celebrity endorsements, and naming rights to the Miami Heat's arena were just a few examples of the extreme marketing measures taken by FTX. Advertising for these products typically guaranteed larger returns than those offered by conventional financial institutions. However, as of November 2022, that was no longer the case. Customers and investors lost billions of dollars due to what was initially thought to be an accounting error, but was later shown to be massive fraud. Alameda Research, a Hong Kong-based Bitcoin trading service, was found to have diverted customer funds to accounts under its control. The revelation caused FTX to start falling apart. The downfall of FTX. From its peak point at the beginning of 2021, the price of Bitcoin began a precipitous slide in late 2021 and early 2022, with other cryptocurrencies soon following suit. While FTX kept buying up rivals, several other large platforms began shutting down. In November 2022, however, CoinDesk published a report claiming that Alameda Research, another company formed by Bankman-Fried, had $5 billion in assets that were significantly dependent on FTX's digital token FTT. The leaked balance sheet revealed FTX's lack of diversification and the company's excessive interdependence. Poorly labeled entries on the balance sheet reflected a negative $8 billion balance. The document contained $9 billion in liabilities and only $900 million in assets. Alameda obtained all the funding it needed from FTX. It was subsequently discovered that the majority of these funds came from client deposits and that the trading firm habitually borrowed funds from FTX customers' portfolios. FTX and its subsidiaries did not follow accepted practices in financial reporting by preparing balance sheets detailing assets and liabilities. Because FTX was a private corporation, its financial statements were never audited. Without these audits, there would have been no proof that the corporation could pay its bills or protect its customers' investments. The numbers on the FTX balance sheets didn't add up to what Bankman-Fried claimed they were. The FTX meltdown. The collapse of FTX in November 2022 lasted 10 days, from November 2nd to November 12th. The leaked balance sheet and the CoinDesk report set the scene. Due to the mishandled and blurred finances, Binance first declared that it would sell every single one of its FTT tokens. Customers of FTX had to withdraw money from their accounts as a result of the sharp decline in the value of FTT. Billions of dollars were lost by FTX during this massive withdrawal. In order to raise the money from the withdrawals, Bankman-Fried gave Alameda Research the order to liquidate assets. He also searched for funding to close the $8 billion shortfall between what was owed and what could be paid. On November 8th, FTX removed the online option that allowed users to withdraw money from the site, preventing hundreds of thousands of users from accessing their money. Inability to cover the $8 billion shortfall led to FTX filing for bankruptcy. Due to poor money management, a lack of liquidity, and a high number of withdrawals, FTX collapsed. In order to stop a worse market meltdown, Binance stated that it would purchase FTX. However, as more news stories about mishandled customer cash emerged, Binance hastily withdrew from the agreement. Lawsuits and criminal charges. On December 12, 2022, law enforcement officials arrested Bankman-Fried on several counts of fraud involving FTX. Money laundering, wire fraud, campaign finance violations, and securities fraud are only some of the 8 counts on which Bankman-Fried was indicted by a federal district court in the United States. Have a story about economics you'd like to see us cover? Leave it down in the comment section below. If chosen, we'll pin you. Bankman-Fried's record-breaking $250 million bond secured his release from jail. As of 2023, $5 billion in cash and liquid assets had been recouped. It was estimated that $8 billion in assets was lost in total. Just as the tremors of the FTX crisis were beginning to fade, another cornerstone of the financial world shattered. Silicon Valley Bank, which had been a keystone of the ecosystem for tech startups since 1983, went bankrupt and is now in the custody of the FDIC. Silicon Valley Bank's high-profile and abrupt bankruptcy, which involved concealing significant losses from its depositors, investors, and regulators, sheds light on the risks that corporate fraud poses to our financial system. The bank's stunning failure on March 10th made it the largest lender to fall since the global financial crisis of 2007 to 2009. SVB specializes in banking and financing for startups supported by venture capital, with a focus on technology firms. Many executives from major IT companies and venture capital firms conducted business there. According to the Federal Deposit Insurance Corporation, FDIC, SVB had total assets of $209 billion as of the end of 2022. The significance of SVB in the IT industry. About half of all U.S. technology and healthcare startups that received venture capital funding were supported by SVB. Because of their willingness to work with high-risk startups, SVB became a go-to financial institution for the tech industry. What caused it to fall? Numerous factors contributed to the failure, including a lack of diversification and a traditional bank run, in which many customers withdrew their savings at once out of concern for the bank's stability. The majority of SVB's deposits were new businesses. Since tech was in such great demand during the pandemic, they deposited huge sums of money from investors, according to Jay Jung, founder and managing partner of Embark Advisors. Investors and owners of SVB lost a lot of money since, unlike SVB's clients, they did not have their investments insured by the FDIC. There were also other problems, such as insufficient funds in recent deposits to cover urgent costs like payroll. Etsy, Roblox, Rocket Labs, and Roku are just a few of the large digital businesses that have substantial funds in SVB. The government insured all SVB deposits on March 12th. A stockholder or an unsecured creditor is excluded from this guarantee. In response to the shutdown of Silicon Valley Bank, the FDIC established the Deposit Insurance National Bank of Santa Clara to house both insured and uninsured deposits. The FTX and SVB scandals are a symptom of a diseased financial system. The system has learned nothing from its past mistakes. Financial elites continue to gamble with people's money and take millions in bonuses while customers lose billions. If you're interested in learning more about finance and money, or if you're looking for ways to protect yourself from financial fraud, be sure to subscribe to Seriouscoinageyt today. Companies, large and small, must have robust risk management and monitoring processes in place to reduce the risk of corporate fraud. This entails having transparent policies and procedures for identifying and stopping fraud, as well as regular training and education for staff members on how to spot and report fraud. Having an effective internal control system is a key component of risk management. This entails putting in place a system of checks and balances to stop fraud from happening in the first place, as well as mechanisms for spotting and looking into fraud when it does. This can be achieved by taking steps like instituting segregation of roles, dividing up tasks among personnel, and carrying out routine internal audits. Moreover, having a solid compliance program is also crucial for risk management. Having a system in place to identify and report potential infractions of applicable rules and regulations, as well as having policies and processes in place to assure compliance are all part of this. The FTX and SVB scandals are a reminder that the financial system is not perfect. However, by taking steps to hold financial institutions accountable, make the system more transparent, and educate the public, we can make it safer for everyone. Thank you for watching, and don't forget to hit the notification bell and subscribe for more.